Welcome back to another engineering economics video. We're looking at chapter 9 in the textbook, which is all about depreciation. And in our previous videos, we looked at several methods of book depreciation. These are methods of depreciation that you would use for your own personal records. And in this video, we're going to look at tax depreciation methods, or at least one method in particular. And these are methods that would be used for reporting your costs to the IRS, the Internal Revenue Service. So I'll try to give a very simplified explanation as to why you would want to depreciate an asset for tax reporting purposes. So we've looked in previous chapters at examples of projects with a cash flow. And typically there's some negative investment at the beginning, and then we have positive cash flow after that, revenues generated by the project. So if we didn't depreciate our asset, all of the cost associated with purchasing the equipment or the vehicle or whatever the project is would all be up front at the beginning in year zero. And then all of that positive cash flow in the subsequent years would be 100% profit. Well, if that's all profit, then it's all taxable. And so you would have to pay taxes on all of that profit. Versus if you take that cost, that initial upfront cost, and you spread it out over time, over the life of the project, then your profit in each year would be your revenue minus the cost. So on paper, it's going to look as though you have less profit. If you have less profit, then you pay less taxes. So you're still making the same amount of money, but you're having to pay less tax. And so that, in a nutshell, is a very, very simplified explanation of why you would want to depreciate or capitalize an asset. And so what I have here is copied and pasted from the textbook, and it's basically how the IRS allows you to depreciate assets. And as I said in the first video from chapter 9, our previous chapters that we've looked at have all been based in mathematical calculations. As I gave the example earlier, if you take $100 and you invest it and you earn 5% on it, you have $105. That's true no matter what. That's just simple mathematics. But this depreciation is a type of accounting, and accounting is subject to not only the rules of mathematics, but the rules of government, the laws of the country or the state in which you are operating. So these things are subject to change. They're not universally true. So, for instance, looking at this excerpt from the textbook, in 1986, the IRS developed this MACRS table, which stands for Modified Accelerated Cost Recovery System. And so that's how assets were depreciated using this particular table, except in September 20th of 2017, or sometime before then, new legislation was enacted that allowed you to use a 100% bonus depreciation or the MACRS table. So you could depreciate the asset sooner. You could use up to 100% of it. You could depreciate it all at once if you wanted to. And then that bonus of allowing you to depreciate all of your assets all at once. And I believe the reason for that would be if you wanted to basically cash in that depreciation a little bit earlier instead of spreading it out over the whole life of the project. If you wanted to take that asset that you've already bought and use all of its book value and depreciate it in a particular year, you could do that to limit your tax liability. So you could basically use it up a little sooner if you wanted to. But then this gets phased out over time, looking forward to the future. In the years of 2024 to 2028, you have a phased down bonus depreciation. And then after 2029, we're back again to using the MACRS table. So we're going to look at example problems in which we do use the MACRS table and not this bonus depreciation that has been enacted and will eventually phase out. So, as I said, the MACRS stands for Modified Acceleration Cost Recovery System. The first thing you need to do when using this table is to determine what is the lifespan or recovery period of the asset that you're trying to depreciate. And so there are various categories of equipment or assets. A lot of what we are going to be looking at is manufacturing equipment, which falls into the category of a 7-year asset. And so if you have a 7-year asset, you would use this column of the MACRS table. These numbers in the table represent percentages. This is the percentage of the previous book value of the asset, the previous year's book value, that you are allowed to depreciate the asset by. So the basic way that this table is set up is it's based on a double declining balance method, with the exception of the first year. And the reason for that is in the first year, you're only allowed to depreciate half of the double declining balance method. And the reason for that is because it's just a way to guess or assume that the asset is put into use at some point about halfway through the year. So you can depreciate half of its value in the first year, and then after that first year, you go to the full double declining balance percentage, and you follow that down until you get to the year with a star next to it, at which point it transitions to a straight line method until you get to the very last year. And in the very last year of the asset, you are only allowed to use half of the depreciation. In fact, that half comes from the half in the first year that you didn't use. So we've got half of the depreciation amount in the first year. Where does that half a year go? It gets tacked on to the end, which is why the 7-year asset actually gets stretched out into 8 years. This would normally be the end of the asset's life right there, but we take that half of the first year and tack it onto the end. That's why it appears to stretch out to 8 years. Okay, so this slide basically just summarizes what I just said. You're only allowed half of the depreciation in the first year, full depreciation for each of the remaining years, except for the last year. The last year you own the asset, you're only allowed half year of depreciation. So if you sell the asset earlier, before its full depreciation is up, then in that last year, the year you get rid of it, you're only allowed to claim half of its depreciation.